My name is Jake, welcome to the channel. In today's video, we're gonna do a review my pie video where I review subscriber portfolios. I've been doing this for about 5 years now. This is the 62nd episode of this series. I really enjoy it. It's a great way to see how different people are approaching dividend investing with different goals, different mindsets, different approaches. But yeah, today is a little bit of an off day for me. I'm gonna be unable to make a video here the rest of the week because I'm gonna be busy. So today is the last day before Sunday. Today's Wednesday, the last day before I could record for the video for this week. But today we kind of got thrown a curveball. I usually don't share personal things about my life here on the channel. I do a little bit, but I don't want to make the channel just about, me and my personal life for the most part. But yeah, in case you care, I spent about half the day in the ER with my son. He had this weird rash, really strong pain in his upper leg, kind of where his, in the groin area. I'm not going to go into too much detail, but definitely some really, really big pain. We didn't know what it was. We didn't know if it was lymph nodes or hernia or what. And so we went to the ER because today, where I'm at in Utah, today's the 24th, it's Pioneer Day, and everything is closed, like urgent cares, they're all closed because it's a public holiday. And it's actually my birthday too, by the way. So that's always fun. Got to spend my birthday half the day in the ER. So that was fun. On top of that, yeah, so being sick or having to go to a doctor here in America is expensive. So we have a high deductible plan. We have an HSA. And just to go to the ER, it's like $1,500 and everything else on top. It's going to be like $2,000 for this visit that we did just to have a doctor take a look at this rash or this issue that my son had. And so, yeah, today's been a day, but I definitely wanted to record a video. And today's going to be the last day that I'm going to be able to do that. Normally I do it in the morning. It's in the late afternoon. It's like 5 p.m. where I'm at right now. So yeah, if I'm a little bit off or if my enthusiasm is slightly lacking compared to normal, if you're a regular viewer of my channel, that's why, because I spent half the day in the ER. So yeah, that's a little bit about where I'm at. So if I'm not on my A game with my memes or my whatever, I don't know, that's why. So in today's Review My Pie, we're going to keep the same format. We're going to take a look at 3 portfolios and 1 question that I got here. The first portfolio is from a 23-year-old here in the US. The second portfolio is from a 24-year-old from England. We don't get a lot of people from England, so really excited about that one. And the third portfolio is from a 48-year-old here in the US. As always, the timestamps will be in the description, as well as the portfolio links will be in the description. And as always, everybody, I'm not a financial advisor. Please don't take what I'm saying as financial advice. It's just merely for entertainment. And as always, I don't pre-review the portfolios before. I'm looking and viewing them live. I don't do a lot of editing on these videos, so it's kind of raw and uncut for what I'm doing here. And that's how I've always done it. And I hope that you enjoy the format because I've kept it pretty much the same here these last couple of years because I really enjoy it. I try to make it as authentic as I possibly can. One of the things that I love about this Review My Pie series is I get to interact with people who are millionaires, and I get to interact with people who effectively are in debt and have a negative net worth. There are all walks of life. There's no one size fits all. What I'm noticing more and more is people are feeling discouraged that they're never going to be able to retire. You see articles all the time that, the average person is in debt up to their nose and that things cost more. And I mean, I can understand why people are discouraged, paying $2,000 or whatever for this ER visit today so that my doctor could afford his BMW. I can understand why people are frustrated and people feel like they're never going to be able to retire. And it can be really discouraging at times. And it could look a little like this. Oh my gosh. Oh man, it's tough out there, everybody. It's tough. All right. So the first question here is from Brian. He writes, "Hi Jake, what was your logic for selling your rental properties in Austin? What encouraged you to get into real estate and what encouraged you to get out of it? I'm trying to decide if the hassle factor is worth it for me. A video on this topic would be awesome. Hope you're enjoying Utah." Brian, he gives some helpful information about him. He has 180,000 household income, no kids, pets. Household. Speaking of dinks, no, that's cool. So you got a house. You have a high net worth for somebody who is. Do you say how old you are? You're turning 28. Okay, so you almost have $500,000 at 28. Was that blood, sweat, and tears? Did you inherit that? I mean, the fact that you're talking about house hacking and everything, you probably didn't inherit it. I mean, maybe you did. There's nothing wrong with that. But the fact that you're thinking about these things at such a young age is really, really impressive. So what Brian is saying here, a few years ago here on the channel, I shared that I invested into real estate in 2019. My parents had always owned real estate. When I was a kid, I grew up around real estate. Now, my parents, this was before the internet, and they had nightmare scenarios. I remember as a kid going to the little duplexes that my dad owned and fixing them up, like cleaning pee off of the carpets and fecal matter off the carpets. That was my introduction to real estate, and seeing people just totally trash my parents' properties and the marital problems that it caused my parents. Half my life, I thought that was going to be the end of their marriage because of all the stress that came with it. Now, my dad really brute forced it because he didn't use a property manager. It was all DIY. And at the end of the day, it worked out for him. And I saw that, and I saw all the struggles that he went through, and I saw the opportunity in it. So in Austin, I invested into a couple of rental properties. For me, I invested in what I understood: single family homes in the Austin market. And I shared an entire video on it. There's a lot of pros and cons there. I think this is also very region specific, right? Like if you're in a city or a state where there's more renter laws and they don't really protect landlords, the squatters and all that kind of stuff, you hear the horror stories. I would probably reconsider real estate. But if you live in an area where, it's very landlord friendly, and you maybe have a network or know someone that could help you, because you're not going to be able to do it yourself. You have to lean on someone. I thankfully made friends with a realtor who helped me find an apartment when I first moved to Austin. And I asked him so many questions, and it was very much a scratch my back, I'll scratch yours. We went through him and bought houses and, gave him some commissions and stuff like that. So it's very much it's a network, right? And, it's a game. You have to know how to play the game. And if you know how to play the game, the real estate game, you got to find someone that can help you and take you under their wing. But to answer I guess it's a good point. I could have an entire video on this topic. But essentially why I got into real estate was initially, I didn't fully understand what I was trying to do. I didn't know what my end game was. I just dove headfirst. And I invested in real estate. Thankfully, the market appreciated. My parents went, 20 years, 30 years invested into some properties and they never appreciated. So timing definitely can play a role. I remember talking to my dad really quick. One of the duplexes that he bought here in Utah, it took almost 30 years for the value to triple. And then a few years before the pandemic, the values almost tripled in just a couple of years. So the timing definitely can play a role, and it's a challenging thing. And so I got into real estate because I wanted the passive income. I wanted the growth. I wanted to leverage my investment. And through leverage, I was able to amplify my returns. Leverage can work for or against you. But essentially, I got into real estate because I wanted to maximize leverage, take advantage of that. And my goal was to never own real estate forever because it's not a passive investment. And so for me, I used real estate as a way to gain capital appreciation. I got in and I got out with my rentals. I did have good timing, right? You can't time everything, but I did have good timing. We still have our house. And what I did is I moved into the house, lived in it for 2 years, and then I rented it, and then I sold it. So I didn't have to pay any capital gains tax, right? So real estate is all about playing the system with legally how it's set up, right? And taking advantage of the laws that are in place. And, that's why I did it. And I got out of it because it's not a passive investment. I wanted to transition the money from real estate into my dividend portfolio. And that's why I did that. And it was a lot of work because I did it myself. I DIY'd it. I didn't have a property manager. I don't recommend having a property manager. I think if you're going to do real estate, do it. Learn. And then later on, if you absolutely have to have a property manager, you could do that. But for you, I think house hacking is a great idea. What I would recommend to most people is try to buy a house if you're able to, buy a duplex if it's available in your area, move in there, and then learn on the job. Learn how to fix your own faucet. Learn how to fix your own toilet. Learn how to call a contractor to come give you a bid on to fix things, right? Understand how, if a plumber needs to come out, understand how you can deal with plumbers and contractors, and live in the house for at least 2 years, and then move out if you're able, rent it. And then if you wanted to sell it within 3 years, having lived in it for the 2 previous years, you could sell it for, no capital gains tax. So there's a lot of things that you could do. I think most people, unless you don't plan on staying in the area for at least 5 years, I don't think it's worth it. I moved around. I lived in Munich. I lived in Denver. I lived in different areas. I moved around a lot. I studied, went to college, and lived in different areas. Unless you're going to stay in a place for at least 3 to 5 years, at least, I don't think it makes a lot of sense to buy. I probably would just rent. And so that's the advice that I would give there. So if you have less than 3 or 5 years, I probably wouldn't even consider it. I would plan for it down the road. And because you just, you could get the timing wrong, and then you might have to sell it, and you could sell it at a loss. You can make money just as well as you can lose money in real estate. So for me, my goal was never to be a retired landlord like my dad. Like even to this day, my dad's in his 70s, and he's still working on his duplexes. He still goes up on roofs and fixes plumbing issues, mows the lawn in our rentals. I guess for him, because he really enjoys it and it keeps him active, but he's a retired landlord. And I never wanted to be a retired landlord. So Brian, I hope that helps. I hope that gives you a little bit of context. I can make a video on it if there's, demand, or if there's people saying, hey, we'd like to hear more. Obviously I could do that. I'm an open book, but there's a lot of other great content on YouTube about real estate investing. But that was my experience, and it worked out well. And if you have further questions, leave me a comment, send me an email, and I'd be happy to answer them. But thanks for sending over the question here. All right, let's take a look at the first portfolio from Kenny. He writes, hey, my name is Kenny. I'm from Commerce, Georgia, and I'm just getting started with investing. I'm 23 years old, and I have a time horizon of 25 to 30 years. Dude, the fact that you're saying that you have a time horizon of 20 to 25 to 30 years at the age of 23, my hat goes off to you, man. Kudos to you for caring about this kind of stuff at such a young age. I'm investing $1,500 a month as soon as I pay off a little car debt I have left. I work for Johnson & Johnson, so I hear a lot about the company and the dividends they pay. That's what initially made me want to start the dividend journey. My plan for the 25% in VGT is to grow that and rebalance it into other stocks once I get closer to my retirement years. My wife and I have combined income of $100,000 after tax, so I definitely want to increase my investment contributions in the future, given that we only have $2,000 in bills each month due to house hacking and living below our means. Dude, this sounds great. You're 23 years old. You're making $100,000 combined with, did I understand that right? Your wife? You're 23 and you're married? The 1950s called, man. This is awesome. I love that people are getting married younger. Like most people, myself included. I didn't get married until I was like mid 30s. So it's great to see younger people getting married. That's something that I don't think a lot of people are doing anymore. I mean, it's expensive. It costs a lot of money. I mean, and also cultures change and everything, but that's a whole nother topic. So on what you're saying here, this is great. So you understand time horizon, you understand about rebalancing, you understand about house hacking, you're investing. I mean, you only have 2,000 in bills, but you're only investing 1,500 a month. It feels like you could be doubling or tripling that. It feels like, maybe not tripling, but doubling. Yeah, once you pay off your car debt, then yeah, trying to optimize that and max out. Because what really matters here, what moves the needle is not necessarily picking the right stock. I mean, that obviously plays a role. And what really moves the needle here is staying out of consumer debt, not spending more than what you make, and looking to make more money. And what you're doing, house hacking, is a great way to make more money and save money. It's kind of both of those. So I think you're in a great spot. I think you understand what you're trying to do. And what I would say is, don't be surprised if that 25 or 30 year gets cut down to 10 or 15 years. Okay. So don't underestimate the power of compounding. And, but what I also wouldn't recommend is living off of top ramen. You're 23 years old, you're married. If you're married this young, you're probably going to have kids. Hopefully you have experiences before you have kids, because life gets a lot more difficult once you start having kids. All right, let's take a look at your portfolio here. You have 10 holdings. You have a good dividend yield. You have a good expense ratio. You got SHD, you got VGT. So this is what you're talking about with rebalancing VGT. You got Costco, ExxonMobil, Johnson & Johnson, Procter & Gamble. You must follow my channel. 5%. Dude, this is great. I love seeing this. You only have 5% in real estate investment trusts. Okay, so I think what you could do is you could probably optimize this a little bit, okay? And the way that you could optimize it is you probably don't need 5% in Coca-Cola. You probably don't need 5% in Procter & Gamble and Realty Income. I probably would reduce these for now, because you said you have 25 to 30 years. Why not reduce these to like 1, 2, or 3%? And then later on, you could then increase them as your dollar cost averaging. Or in 25 years, when you sell VGT, which will have much more growth than Coca-Cola, Procter & Gamble, for example, you could then buy Coca-Cola with the sale of VGT. So I would optimize it that way. It's nitpicky, but it's a pretty big deal, because if you got like 15% in 3 stocks that are pretty low, I mean, I would even lower ExxonMobil. Like Exxon, Procter & Gamble, Realty Income, Coca-Cola, I would lower those to like 1 to 3% each, okay? And then what I would do is, well, where's your DGRO? Where's your VIG? Where's your dividend growth ETF that you are going to hold? So what I would recommend is considering adding a DGRO in here, because you want the dividend growth. SHD is great, but you don't get very much market participation. If you've seen my other videos, especially my videos on Thursdays, you know that I've shared this quite a few times, that SHD only has 7% overlap with the total US stock market. Okay, so you want to get more broad exposure to the market. And one way that you can do that is combining it with a dividend growth ETF like DGRO. Okay. And so that would be my opinion. It sounds like you're following the core and satellite approach here. And so what I would recommend is lowering these higher yielders, lower them. You can keep them in. You could always increase the allocation later. I do like that you only have 10 holdings, but I would add in my opinion, I would add a DGRO, and I would, maybe lower some of these others, add a DGRO in there. And and then as your goals in life change, you just kind of reevaluate. But now, once you have this, then it comes down to those 3 things: staying out of consumer debt, not spending more money than what you have, and, living below your means, and then looking for more way to invest. How can you maybe side hustle, or you're maybe get a raise at work, you're doing really well, or you're house hacking. How can you get an extra $100 a week more into your portfolio? Because that is what's going to move the needle. It takes money to make money. So I think you're in an incredible spot. I hope that helps and gives you a little bit of context of how you can look at this. And I think you're doing good. Thank you so much for sending over your portfolio. The next portfolio is from Jaden. He writes, "Hey Jake, I'm a big fan of yours and love the work that you do." Thank you so much, man. I appreciate you saying that. I even got into creating my own YouTube videos because of yourself. That's awesome, man. I wish you linked your channel here. I'd check it out. You're 24 years old from London, England. I work in recreation. I'm not sure what rec means. And make around 40K, give or take. Pretty grateful as I live with my mom. Mom, I love that, British. So expenses are super low. Currently invest a minimum of £850 per month and much more on months I have coming in. The biggest dilemma I have is that I have £28,000 in a trading 212 in an ISA account, but also 16K in a high yield savings account. I know at my current age, I can be a lot more risky with stocks and put a much higher percentage of cash into stocks. My question is, do I move the 6K directly into my trading 212 account, therefore maxing out my ISA for the year, or should I put it in a taxable account and just put it in monthly amounts towards my ISA, max out by the end of the year? My thought process is, if I want to put the 16K in my trading 212, it wouldn't make too much sense, as I would preferably not dump 16K in the stock market at once, but rather average in over the months. Yeah, absolutely. Whenever it comes to lump sum investing, what I always say, just across the board standard, if you have a lump sum amount, invest half today and then the other half over 3 to 12 months is kind of average of what I say. Regardless of your situation, regardless of where the market is, half today and the other half over the next year. Would love to hear your opinion on the above, as I'm in a little bit of a pickle. As I'm in the UK, not sure if M1 is applicable. Okay, so you don't, M1's only in the US. My goals are 65 to 70% of my portfolio is in the US stock market. Okay. Okay, and you got a few other individual stocks: Visa, Apple, Google, Tesla, United Healthcare, Walmart, AbbVie, Procter and Gamble, Realty Income. Okay. So when it comes to your other accounts, the ISA, I believe that's like, your retirement account. It really comes down to your goals. It's no different in the United States. If you invest into a retirement account, you're restricted on when you can take out the money without a penalty. And so that's the dilemma, is really, well, where do you put the money? And what I would recommend is, you're not going to have all the answers today. You're what, like 24 or something? You're not going to have all your answers today. So with that understanding, what I always recommend is give yourself options. Be flexible. And what that means is you don't go all or nothing. Don't do 100% of one thing and 0% of another thing. As long as you don't understand what your goals are, I would go and I would try to diversify across different accounts. So that's what I would say. So if you're in the US, I would diversify across a Roth IRA, 401k, and a taxable account if you think that you're going to retire before the age of 59 and a half. If you know you're going to retire after the age of 59 and a half, for example, in the US with a retirement account, go 100% in your retirement accounts. So it all depends on your goals. And that's why this is so challenging, is you're using your best guess. Okay. And so that would be my recommendation, is don't go 100% one way or the other. Have a strategy with how you invest the money. Like you said, don't do it all at once. But yeah, you're completely right. Especially with a 24-year-old, unless you don't have an emergency fund and you can invest the money, I would definitely get that money into the stock market and helping you start to build wealth, because it's not going to, savings rates are great now with interest rates the way that they are, but the question is it going to be like that forever? So yeah, you want to get that money working for you. And that's what a lot of people, you don't learn about this stuff in school, guys. What the rich understand that the poor don't is, You work hard for your money, but you need to invest so that your money can work hard for you. Okay? It's like that old Warren Buffett quote. I'm going to butcher the quote. If you don't find a way to make money while you sleep, you're going to work until the day you die. Essentially, I think I butchered it a little bit, but I know that quote gets way overused. It's like way overhyped, but it's so true. If you don't find a way to invest your money where it produces money for you, then you're going to be reliant only on your active income, and therefore you're going to work until the day you die. Okay. So that's why I think it's so important that you understand this. And it's great that you're understanding this at such a young age. You're keeping your expenses low. The individual stocks, pick the individual stocks, the investments that work for you. You watch my other videos when it comes to how to invest based off of your investment time horizon. Look at your investments as a vehicle. Your vehicle, you pick the vehicle based off of your destination. And your destination is when you plan on living off of your investments. Okay, so you've heard me say this many times before on my channel. Your stocks, ETFs are just vehicles, right? How are they going to get you to where you're trying to go? And here's the challenging thing. If you don't know where you're going, how are you going to pick the right vehicle? So it all comes back to understanding your goals and your destination when you plan on living off of your investments. And while doing that, the vehicles should be diversified in this case, not having more than 5% in an individual stock, right? Stuff like that. Diversifying, following the core and satellite. If you follow my approach to investing, the simple path to wealth with dividend investing, which was inspired by J.L. Collins. For me, that's SHD and DGRO and then ETFs. But I believe in Europe, you're not able to invest in SHD and DGRO. So finding a comparable investment would be wise in that case. But yeah, so that's what I would say to that. I think I touched on most of the points that you made here in your email. But yeah, I mean, it comes back to you're still young, understanding your goals, and understand that your goals are likely going to change. Don't overcomplicate things. And I guess in your particular case, once again, I'm repeating myself, don't go all or nothing. If you don't understand what you're really trying to do and you're second guessing yourself, the best thing that you can do is give yourself options. And that's what I would recommend. So I hope that gets you a little bit out of your pickle and gives you a little bit of a different way to think about this. Don't overcomplicate it. Life is hard enough. You're not going to, ruin or derail your financial situation if you, just change things slightly, right? So don't look at this as, you have to get it 100% right. Like, don't think, oh, do I need 4 point, is this ironic? Is this like 420 in Tesla? Are you, okay, let's use a different example. I can't take that serious. If you have like 4.9 or 4.1 in Apple or 3.7, it's not going to make a material difference. It's not going to move the needle very much. So don't lose sleep at night over, is this 4.9 or 3.6 or whatever, or 4.2, 420? Like, do what you got to do, and don't lose sleep over the little things. Even though I know that that's the hardest thing to do, especially for me as well. So yeah, thank you so much for sending over your portfolio. I hope that helps, and I appreciate you watching the channel all the way from London, England. All right, let's take a look at the last portfolio from Alex. Alex writes, "Hiya, Jake. I hope this link works. I finally opened an M1 account. I have $575 invested. I bought a few ETFs I see others talking about on YouTube." That's a red flag. It could be good or bad. "I'm 48 and now plan to retire at 55. I have a 401k and an ESOP with my company." Is it ESPP? Probably ESPP. Close to 500k. Does this look good to invest in more into? I have no debt aside from 50k left on my house, which will be paid off in the next 3 years. I hope. Wish I started investing 20 years ago. You and me too. You and me both. Instead of investing into the market, I have bought a lot of silver and gold, but they do not pay any dividends. Really? Silver and gold don't pay any dividends? Really? I thought that they paid dividends. Everybody talks about gold. You should invest into gold. What does gold produce? Nada. Well, it could be made into something, but gold itself doesn't produce anything. So thereby, only companies or things that produce something pay a dividend. Yeah, just insurance if Shiza ever hits the fan. My safe is full, and I'd like to start earning some passive income. This guy's got a safe full of silver and gold, and who knows what? Probably some like big artillery and all that good stuff. Some end of day doomsday stuff as well. So I like this guy already. Or a girl. I mean, Alex. Could be a girl or a guy. It's probably a guy. But maybe it's a girl. Probably a guy. I'd like to hear your... Yeah. I'd like to hear your advice if I should change anything or if I should add or delete anything from my pie. Appreciate any advice. Thank you for your time. Look forward to hear your advice. Thanks, Alex. Okay. Well, Alex, this is awesome, man. I think, you're at that age where it's like so close, but yet so far away because you're 55. You're going to be retiring shortly before you can access your 401k and your Roth IRA. So what you need to do, you're in the unique situation, the unfortunate situation. I call it unfortunate because it's like, you're kind of on the fence. You could jump on either side when it comes to this. You're on the fence where you could either go full blown in your 401k, in your retirement accounts, or you could go full blown on your taxable accounts and try to do it that way. The short answer is I've had multiple calls with people where I've talked about this and simulated this for their particular situation. I do, people can book time with me, and I've had a handful in the last couple of weeks who had exactly this scenario, and I walked them through the math and in different scenarios of how they could look at this. If you want to book time with me one-on-one, there's a link in the description below. You can do that. I don't charge a lot of money. I don't charge like what a traditional financial advisor would charge, hundreds and hundreds of dollars. I don't do that. It's pretty affordable. It's, I'm not selling anything other than my time. And so if you want to walk through this one-on-one, I do offer that a couple of times a week. But this is a unique situation where you could go either route. You could go full-blown on your retirement account and try to make it work in your retirement account, or you could find a bridge where you're investing enough money where you can liquidate your portfolio from 55 until 59 until you can access your 401k and your Roth IRA. So it's hard to say. I personally kind of lean more towards finding a bridge while focusing on your retirement accounts because I much prefer tax-free income. Okay. And so I obviously don't know your entire situation, but on the surface here, I generally would recommend seeing if you can find that bridge, how you can get enough money to survive off of. I guess we're talking about survival. He's got a big safe full of gold and silver. So this guy's a survivalist. He's probably an Eagle Scout. So he's probably prepared. That's what I would recommend, considering both options, investing fully in your taxable accounts or finding a bridge, a way to survive off of your taxable income until you can access your 401k and then Social Security, et cetera, et cetera. Let's take a look at your portfolio. And when it comes to the silver and gold, I mean, silver and gold have done so incredibly well the last couple of years. So I always like saying, reevaluate your situation. Do you need the money because you're not making any income off of that gold? Gold is great to preserve your wealth. Gold generally, though it's appreciated very, very much in these last couple of years, gold is not really to accumulate wealth, but rather to preserve wealth. And so I would just look at your particular situation. Maybe you could use that gold to bridge until you can access your 401k, for example, your Roth IRA. I don't know. But let's take a look at your account here. You got 10 holdings and you have a very low dividend yield, low expense ratio. And let's see what you got in here. You got only ETFs and they're all equally weighted. So, and this is where you said in the email where you pick these ETFs because of other YouTube videos. Man, this is why YouTubers have to be responsible. People actually listen, and I'm myself included, obviously. People listen to what YouTubers say, right? If I made a video on a specific ETF or stock, I know that there would be a percentage of people that would listen to what I say and buy it or sell it. And so I try to be responsible whenever I don't only try, I am committed to being responsible when it comes to talking about ETFs, stocks. I would never, ever recommend anything to any one of you, anything that I would not recommend to my dad, to my wife, to my friend. So that's how I hold myself to a high standard when it comes to that. I'm very careful of what investments I recommend on YouTube. And so it just very clearly here in this email, this guy is listening to other YouTubers. Thankfully, you listen to some good YouTubers. These ETFs, for the most part, are very good for what they're designed for. A lot of these are growth, and they're not ideal to live off of the income. So the way that you want to look at this is an ETF, a stock, is no different than like a rental property, right? We talked about at the very beginning of the video, I bought my rental properties to buy them low and then sell them high. The exact same thing applies for stocks, ETFs. You can buy the stock today with the intention of hopefully trying to sell it in the future for more and to have a gain. The alternative is you can buy a house, a rental property, not plan on selling it, but just living off of the income. And that is the equivalent of a dividend stock or a dividend ETF. And so this approach, these different ETFs, they are different vehicles. Once again, the analogy with the vehicles, they're different vehicles to help you get to your destination. Okay, so it's incredibly important that you understand what is the purpose? Why are you investing into SPYG? VUG, SCHG, QQQ, and VGT. These right here, let's see if I can do math. 1, 2, 3, 4, 5. 50% of this plus VTI, 60% of this portfolio is like a flip. Buying a house low and selling it high. And if that is not your goal, if your goal is to live off of the dividend from these, you are absolutely crazy unless you're a multimillionaire. Okay, so you have to understand that you're investing into these so that you can sell them in the future and then buy maybe a house, maybe something else, or you can rebalance into a high dividend ETF like these or like these. So Alex, what I would recommend is you need to kind of take a step back and understand, well, what's your goal here? Because unless you understand what you're trying to do, it can be make it very difficult. So you know how I talked about the bridge, right? Bridging from 55 until 59 and a half. This is a great way to bridge the gap, right? You can invest into these growth ETFs with the intention of them, appreciating, and then you could sell them once you retire, live off of the selling the shares until you are 60 or 59 and a half, where you can live off of your portfolio in your retirement account. So you really got to you're in a tricky situation. You're in a scenario where you have multiple options, which can be good and bad because it's like going to Baskin Robbins. Too many options can make the decision very difficult. So you want to understand what is your goal here? What are you trying to accomplish? Because you're the only one that can figure that out. And it can be difficult when you're watching different YouTube videos. You want to make sure that you're watching a video, you're thinking about this, that's going to help you to really accomplish what you're trying to do. But here's the thing is, if you don't know what you're trying to do, you don't know what your goal is, you're going to get swayed left and right and be all over the place. Okay, so that's what I would recommend. But the analogy with the house flipping and the rental properties, the dividend income, the flipping, that's how I think most people can understand that. That's how I understand it. The VYMs, HDV, SHD, and DGRO, these are ETFs, 40% that you would never sell. Those are your rental properties, your dividend rental properties. The rest, VTI, VGT, and the rest are ones that you would want to sell. And just kind of nitpicky, QQQ is a good ETF, but for most people, you would want QQQM. It has a lower expense ratio. Okay, so just very nitpicky, but if you're going to invest into QQQ, go with QQQM. It has a much lower expense ratio. Okay, QQQ is great if you're like an options trader. Okay, there's a lot more volume. But for most people, you would want the M version of that. I gave you here a few nuggets, a few pun intended, gold nuggets. Oh man, gave you some nuggets here to think about what you could consider. But it really, you want to go back to the drawing board and truly understand Well, what's the purpose? Why? Where are you investing the money? Why are you investing the money? How is it going to help you achieve your goals? So I hope that helps. If you give me a little bit more context, or you leave me a comment or send me an email, I can expand on it a little bit more, or you can book some time with me directly and we can talk about it. So, but Alex, yeah, thank you so much for sending over your portfolio. Everybody, I hope everyone has a great week, and I'll see everybody in next week's video. Thanks for watching.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.